Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone. Welcome to the Millionaire Next Door podcast. So pleased you're joining us. Today is May 15th, 2025, as we record it. There is an awful lot going on in markets, really since the April 7th low and things coming back. We have a repeat guest who's terrific. This is Miles Clark. Many of you know Miles because he's been on a few times. We like to have Miles quarterly because he's just been so helpful and really understands what's going on and helps explain it in a way that I think adds a lot of value. We heard him last on episode 66, recorded on January 21st of this year's 2025. Almost feels like a little bit of a different world, right, Miles? So
Yes, certainly. Yeah, no, I was looking at the performance just in kind of preparation for this meeting. Well, first off, actually, it's great to be here. Absolutely wonderful. It's, it's nice to be able to sit down and talk about it. But yeah, talking about a different world, S&P 500 off about 2.5% or so. It's climbing its way back up, at least at the time of this recording here, climbing its way back up to positive on the year. But that doesn't tell the full story, of course, right? We've got massive swings in between there and now. The tariff news back and forth, sending markets up 10%, down 10% at will. So it's certainly been a really busy quarter since we last chatted, and I'm excited to get into it today.
Yeah, that's great. Because there is so much going on under the surface, and it really is. I've been doing this north of 27 years now, second and third generation clients, but this time around was really, I just felt the acute nature of the client concern, the worries, just a lot of anxiety. Spoke to some CPAs who were saying the same thing from their clients. So to guide folks through that, and there has been a recovery, so we'll really get into that. But that's when those conversations really matter. And frankly, that's the reason I became an advisor, to guide folks through that, the sounding board process and things like that. You can add a lot of value. I reached out to someone who had expressed interest in working together, and we've been trying to connect for a long time. And she's a CPA, and she said, boy, I'm so glad I'm not you and having to deal with this. But those are the conversations. So it's been pretty interesting. But yeah, well, let you launch into it and share your thoughts. I do want to just repeat before we go there, and I've said this in the past, if anybody is really feeling anxious or concerned or had a real gut check from this process, please feel free to reach out. I'd be happy to review, go over things with you, even as just a public service announcement, because it did engender a lot of anxiety and worry that I saw. A few folks weren't too worried about it, but some were really more unnerved than usual. So
yeah, no, I mean, and that builds on it. I mean, it's so important to have a general idea of, or someone just kind of by your side to talk things through, right? You do it for your clients, we do it for you, right? At Dorsey, right? And kind of talking through, what markets are throwing at us. And the most important, I'll kind of open up with the stat here that kind of exhibits why. A lot of people will look at the longer term average. I did some Excel work before the call and went back to 1970. Just look at the S&P 500 returns, just on calendar year to calendar year. You're averaging about 9.5%, right? That's the number we're all familiar with. 9.5%. You can pick up maybe a little bit more in recent time on average, whatever it is, but in between 9 and 10%. Robert, gonna put you on the spot here. How many times do you think that the actual return was within 1% of that 9% number going back to 1970?
Very few. Maybe never. It never hits that number, but you tell me that's my guess. So.
Yeah, two times. So, throughout the 55 years that kind of look back, it's almost never average, right? And so the kind of point of that is that we can plan on quote average returns, but it's probably not going to be that way. And so having a systematic way to look at what markets are throwing at you can really help kind of you decipher, sorry for rambling there, kind of stuttering, but to help you decipher exactly what markets are throwing at you, because the average of 30 and the average of 0 is 15, right? But those are two drastically different outcomes that you're going to interpret very differently as you are going through, right? Maybe you go out and you buy a new car if your portfolio is up 30%, right? That'd be a lot of fun versus, if you're flat on the year, or even worse, maybe you're down. I think things look a lot different, but you're still at that long-term historical average, right? So I think that's a kind of pretty important piece to put in context. It helps put some clarity around it.
It is really important because usually the further you back out, sort of the lens, the better perspective. The sort of newbie folks or people who aren't so used to markets, I think their sort of expectation is things will move in a straight line, fairly
Right.
linear, but it doesn't move that way at all. It bounces up and down all over the place. And as you've been in these markets for you have to be comfortable with that, or just maybe comfortable with being somewhat uncomfortable, but saying that's okay, I can deal with this. You guys have made me super aware of the fact that sometimes the biggest up and down days, in either direction are oftentimes clustered very, very closely to one another in time proximity. And you need to be really careful when things are moving. They can move back. Look at this time around, right? How quickly it moved back. So the
Yeah,
perspective
no,
is important. Yeah.
it's a really good point. I mean, when you think back to COVID, right? You think back to quote Liberation Day, where all of our portfolios were liberated from the gains that we had this year. I say jokingly, but I mean that these are the types of periods where you look at it and markets down 4%, and then that afternoon you get an intraday rally and you're up 3% for the day, right? And so these things, especially in a post-COVID world, markets are moving around extremely quickly. And just for context, I listened to your podcast from a few weeks ago with Gary's Cinderbrand, I think his
Yeah.
last name is
Yeah.
called,
Yeah.
kind of putting some perspective around some of the color or weeding through the noise, similar to what Dorsey does.
Mm.
Great podcast, by the way, for you, those of you listening to this one, definitely go check that one out. But there's so much news nowadays that you can be inundated with everything that's coming at you. It's so important to be able to look through and say, okay, hey, I had a plan at the start of this year. Yes, the portfolio looks like this, but this is the plan that we talked about. And this is how we're going to step by step walk through this, instead of letting the headlines and the emotions that you're feeling really drive it, because that's when mistakes are made. And just like you mentioned, Robert, just now, these periods where you lose, or where you're getting these big swings, right? The down 3-4% days, they often cluster together with some of the bigger gains as well, the up 3 and 4% days. So it's very important when we are around those points to not sell at the wrong time, which is a lot of us what a lot of us want to do psychologically when you see everyone else heading for the exit sign as well.
Yeah. Yeah. 100%. Part of the process I sort of, Bill, I call it objective, unemotional, rules based. But another big factor is sort of tuning out the noise to to really focus on the important signals. Now, granted, there was an awful lot of noise going on, but you can see people how they behave under stress or duress, or they get on a fixed mindset. And to have that partnership or that conversation, what you guys do is look at this data, and it's just so helpful. I mean, you were sort of be cautious through this, but yeah, having that process and because you do see mistakes made when there's a lot of fear and anxiety, and maybe having a little bit of a check system. The interview with Gary, we talked a lot about, Dorsey, right? Tom was a instrument trained pilot, and went through the details, and Gary is as well. So we went through an analogy of how you can get highly disoriented, if you don't follow the instruments and you sort of go visually and try and do it by eyesight. So that was he gelled with that exactly. So the process is key.
Oh yeah. Well, and it's a process, and maybe now we can kind of jump in.
Yeah,
That's a lot of high level stuff, but I think
right.
what everyone is actually listening to is what is Dorsey Wright seeing, right? Like what is actually, it's good to be able to talk about the last month and kind of
Yeah.
look at it in the rear view, but what are markets actually giving us as we move into a relatively weak part of the year? I mean, so we can
Yeah.
start just very briefly with a comment on sectors or seasonality within the
Hmm.
markets. The old saying is sell in May, go away, and come back later in the fall. Most of the time, May has actually been positive for the most part. So maybe that's a good sign for markets as we kind of are sitting here about halfway through May. Maybe as you're listening, you'll know exactly how May ended up. But point being is that what type of themes has Dorsey Wright been seeing as we start this seasonally weak part of the year? And the answer is we've really seen a preference for growth off of this rally, right? And so Dorsey, right, just for the uninitiated here, just very, high level analysis on what we do. We're a technical research based shop that focuses on price movement. So everything is going to be driven by the buyers and sellers within the market. When there are more buyers, just like regular supply and demand, when there's more buyers, price rises. When there's more sellers, price falls. And so we believe and understand that if we can take hold and capture those trends, that can lead to enhanced performance within our portfolio on a relative basis as well. So it's not about just finding the asset that goes up 10%. Like if Apple goes up 10%, that's one thing. But if Microsoft went up 20, right, that's you'd rather be in Microsoft. So it's one, finding trends just broadly, and then two, it's comparing assets against each other. So relative is actually the name of the game. And that's important, right? We're all comparing ourselves, keeping up with the Joneses, right? You're comparing yourself to a benchmark or your neighbor's new car or whatever it may be. So, relative analysis or comparison is something that we're all very used to subconsciously. And that just kind of flows over into the markets as well. But for the most part, and like I mentioned, and then I'll let you go, Robert, but for the most part, we've seen growth focused areas kind of really rising off of these lows. I won't say Dorsey was completely right when it came to the exhale. We did see a couple of more defensive toned natures or posturing throughout the April exhale, but we've seen that kind of reverse and really kind of move back over into the camp of technology, growth, large cap, kind of core focused areas. And that's some interesting developments, which which we'll dive into more in just a moment. But really, that's the driver of this recent advance. Excuse me.
Yeah, yeah, it's super helpful. I utilize it and employ it and really utilize it to help manage client portfolios and assess risk. I might take a little bit of issue. I with one of the things you mentioned, just not issue, but you mentioned I think human behavior is to try and keep up with the Joneses and or exceed the Joneses, but that's really kind of a not a great perspective in my opinion, because it doesn't matter what someone else is doing. What's going to matter is what is important to you, to your family, to your legacy. What's your risk level, what you need to do the things you want to do and live the lifestyle you want to live. It doesn't really matter what the Joneses have. That's really a very false comparison. I know in life, if you're always trying to compete with someone else, it's not a great recipe for success. So we touched on this a lot in the Gary Cinderbrand episode, but what's important to you? Maybe you only need a 6.6% rate of return, and you can live with a lot less volatility. Let's build something around that. So that perspective is key. Back to you, but I just wanted people to keep that in mind, and we'll get very personal on that. But that's important to keep a focus on. But I think it is human nature. They just want to, I'll get these people all the time that are like, oh, well, we're not beating the S&P. And I'm like, well, your risk is 66% less, and you
Right.
told me you're fearful of markets and that you only need this. And now you're comparing to the wrong yardstick. If you're 65 years old and you're comparing yourself to a 25-year-old in terms of endurance, that's
Right.
probably not the right comparison. But at any rate, yeah.
No, yeah, and I do want to clarify. I don't think it's correct for people to compare themselves to each other. Of course, what's going to be most important is what's exactly that, most important to the individual. But like you said, I do think that people subconsciously do it.
Yep.
And, even you mentioned for your clients, they compare themselves to the S&P and they don't necessarily think about the lack of risk that they're taking on. So certainly don't get me wrong. I'm not advocating else that anyone just goes and tries to keep up with their neighbor and do that. But I do think it is an unfortunate reality of life that
Yeah.
people do compare it. And to that point, where I was really getting at was the most important part is Dorsey Wright compares assets to each other to see which one is stronger. So again, don't compare yourselves to your neighbors. Certainly do what's best for you, but at least in relation to assets, hopefully the one that's relatively stronger we can continue to look towards. Speaking on stronger assets, we've seen a really large increase in interest so far this year, a lot of inbound client calls and things like that on international equities, right? Domestic
Right.
equities clawing themselves back to flat for the year. Of course, what's been a pretty turbulent market environment so far. International equities in a somewhat surprising environment. I mean, you think about Trump and certainly not getting political here, but it's really been kind of an anti-America last 6 months or so post-election as the dollar has gotten weaker. International equities have moved higher, right? That's been an area. Commodities also strengthening. And so you've seen areas outside of the domestic front really gathering interest, gathering relative strength on the platform as well. International equities doing quite well, and at least from a performance perspective, better so far this year than their domestic counterparts, excuse me. That's something that you're going to have to digest as well. And Robert, maybe a question for you. How do you personally, well, I guess two-pronged question. First, have any clients been calling you talking about international equities, gold, whatever it may be? And then two, how do you typically approach deploying capital to those areas in the overall allocation perspective?
Yeah, good,
Field.
really good question. With respect to international equities, no, nobody's approached me and asked me that. The approach, we do follow the data. They've been very out of favor for quite some time. So this is really, and tell me if you agree, pretty much of a new thing where international has moved up. And I'll ask you to comment. Maybe it's the decline in the U.S. dollars having a big weight, but it does tie in with a couple other issues. But I'm not getting much questioning on that, and I've underweighted that dramatically for like the last 10, 15 years, and it's been very successful. Most of the competitors I see, and what I do is a very custom model of building what works. Momentum, relative strength is a big part of that. So that helps me avoid areas that are weak and stay in areas and have big winners for longer.
Right.
I'm watching the international developments, but for the most part, most of my competition across the whole industry, for the most part, puts one in one of five models, kind of, and those tend to have 20, 25%, some really healthy allocation to international. And we've just largely avoided it for a long time or minimized it. So it's been a successful strategy. So we're obviously watching if the trend or calculus changes. With respect to gold, I have gotten some questions on that. And it's been a very, very hot asset. It's kind of more of a safe haven thing.
Maybe.
Maybe.
Right.
Yeah, there's
Yeah.
no yield, so that's an interesting one in commodities. You can get maybe 4.3% on a T-bill. There's no yield in gold, but it got very, very hot. There's no industrial use for gold for the most part, right? Unlike copper or palladium or things like that. But I've gotten a few questions. People ask about cryptocurrencies and Bitcoin too. That's one we haven't really used, but I think that's sort of a keeping up with the Joneses kind of thing. But let me continue. But I hope I answered your question there. So yeah, people
No, yeah,
do
you,
ask.
you
Yeah.
did.
Yeah. And then I will say sometimes when they do ask, or let's say they do they're considering it, we might be able to direct them to something that's a very sensible way to do that. If one does want exposure and these ideas make sense, use this security or maybe this ETF, as opposed, because there can be a multitude of choices, right? What would be the best way to do that? What would be the proper weighting? You measure overbought, oversold. What's the timing? You measure relative risk. That's really important to let people know. Hey, this is a 3.21 relative risk. It's 3.21% times more volatile than the S&P 500, for example.
Right.
And are you aware? You got a little nervous when the S&P was moving. This is north of 3 times that. You just be aware of what you're dealing with. So, at any rate,
Yeah,
hopefully
no, I
that
mean,
helps. Yeah.
yeah, no, it does, and I do want to go back to the international thing for just a moment
Yeah.
because, and what you mentioned is, well, for the most part, for the last 10, 15 years, you've been underweight international equities, which, and people might think, well, Robert, domestic equities are flat for the year. International equities, you look at EFA, for instance, that's up 10, 12, 13%. You're underperforming, right? But in the most part, for the most part, momentum is built on long, outstanding trends. And so I would certainly agree with you. I mean, international equities have certainly flexed their muscles so far this year. If we kind of go the other way, your client doesn't want you to change their entire allocation just because something has outperformed by 10% in a year, right? That's not a sound investment process. And so at Dorsey, and I imagine you subscribe to this as well, being a Dorsey follower, we wait for confirmation. Momentum is never the first one in the room. It's never the first one to the party, but it's
Yep.
built on outstanding long trends. And so over the last 10 years, 15 years, there's certainly been points where international equities probably had their time, their 2 or 3 months in the sun over domestic equities, right? But for the most part, that kind of longer trend has stood strong with domestic equities. And so again, we've seen nice strength from international equities, due in part, like you mentioned, to that weaker US dollar so far this year. That's going to be a chart that we're definitely watching, a relationship that we're watching. If the dollar does continue to weaken, that would be another tailwind for the international space. But to your point, we're not just trying to chase what's done well so far this year just to make sure that we're up over the course of 5 months. We want to make sure that over the course of the decades, as you're building out your financial picture, that we're keeping on top of relative strength. It's not about what's happening this week. It's not about what's happening this month. It's about what's happening this decade. And so keeping on top of strength over the long term is what's most important. And maybe we are at the forefront of an international dominated decade, but we don't know that yet. And that's not something that momentum or kind of the trend has told us just quite yet. But if it does, the nice thing about momentum is it's flexible and nimble enough to move towards that space if need be. So
Yeah, that I agree. You guys do a really good job of tracking what the data, where what's moving, where the puck is moving, where maybe what's in control, supply or demand. I'm thinking about this with international. So they've improved, but there's still sort of this concept. I keep hearing American exceptionalism. Are you familiar with that? Okay. I
yes.
mean, it is, and it is interesting. I mean, we really, we have the Nvidias, the Microsofts, the Apples, some of the best in the world at what they do. Other, irrespective of maybe DeepSeek, and we'll see where we go. There is a premium here in the U.S., right? And maybe stocks was just at a conference in Carlsbad, California. They were talking a lot about international and how maybe there's some better values. They are cheaper. So those are things to keep in mind. But, I looked at sometimes when I see through your stuff, all the data I can parse, and you see where maybe you look under the surface and you see international, what's the leading? It might be Argentina, for example. And then you're like, that's interesting that things are going to Argentina, but I don't know that I really want to allocate my clients' funds to Argentina. You know what I mean?
Right. That's not the
And
best for the client call.
as much as they complain about here or they don't like the ball, I'm like, well, why don't you go to Argentina and see how comfortable you feel? So
Yeah,
sometimes,
Robert, you're fired.
yeah, if I saw Switzerland or, maybe Germany, but so any rate, I do, I put some of those fundamental things on it too. I sort of think they're really, you might see Italy show up and then, people who go to Italy know it's a struggling economy since World War II, right? They need like tourists, and there's some really cheap real estate there too. So, I think it's a good combo to look at both, but to see where it's going. So,
Yeah,
at
and,
any
and
rate,
and a
yeah,
lot of times people think this type of stuff is a complete on and off faucet, right? So if for instance we say that international equities are doing relatively better in the near term than domestic equities, a lot of people kind of forget that hey, you can still have exposure to domestic equities. You can just put a little bit more in international equities, whatever it may be. It's not like you need to have
Yeah.
100% of your portfolio, your equity portfolio in internationals. It's not just a complete, hey, tomorrow we wake up and we're just all into, internationals here, right? This is some type of stuff where if we start to see relative strength, you can start kind of tier in exposure. And if that trend does persist, then you've got some old exposure, you've got some new exposure, you're kind of dollar cost averaged in. And if that trend is strong enough, then you're certainly glad that you picked up exposure over time. But if it's not strong enough and it turns around, then you're certainly glad that you didn't put the full swoop in there at one time. So again, it's important
Yes.
to remember that you're not doing that type of stuff either.
Yeah, I love the concept of the dimmer switch. I love them in my home, to be honest, versus a totally this bright light, or you could kind of ease into it, turn it up, dial it down. We might start taking some exposure to certain things. But, the other thought is a lot of these big American companies are global multinationals selling all over the world, right? And then Apple, for example, but that got kind of challenged, right? With the tariffs, the rules changing all the time. It put a big element of uncertainty onto things. But I love seeing what, you guys have so many models out there, and I can follow which sectors, whether it's international, is it commodities, within the commodities. It's just super helpful. So
Yeah, and listen, I don't want to take up all our time with internationals. I know it's not the most
yep,
fun to listen to two guys drone on about China and Argentina. So we'll kind of shift gears slightly with the time we got left. I do want to
please.
at least make sure we hit on some of the sector
Yep.
focused areas that we've seen strengthen as we're moving further into May. As I mentioned before, growth focused areas have been a big point of strength coming off of 2025's bottom. Technology, which was previously a leader throughout 2023 and 2024, pretty much exclusively strength from the Magnificent Seven, they fell out of favor. They fell into the bottom half of our sector rankings over the course of the recent exhale, have subsequently moved higher back into the top half, but they're still kind of on the outside looking in of the top half there. So they're not necessarily an overweight. This is going to kind of be one of those areas that we're probably just going to be market weight on technology. We've seen some strength, but of course, if we do roll over, right, technology is going to be the first thing that goes. So, you've got communication services, which is a little bit techy, but this has been pretty interesting to me to also note that the services quote part of communication services, so you're like your T-Mobiles, your AT&Ts, those guys have also done pretty well so far this year. And then financials also doing particularly well, industrials flexing their muscles, and utilities also doing pretty well. Now, the argument is how defensive are utilities really, right? Because you had that whole thing last year, if you remember, where utilities were a semiconductor play, interestingly
Yes.
enough.
Yes.
So who knows if that's going to be the case? But that's where Dorsey stands in terms of those sectors that have some relative strength. Again, utilities kind of rounding out the overweights, financials, communication services, and industrials there as well.
Yeah, it's interesting. You mentioned utilities. I've generally not liked them. I know they've sort of taken on a hot dot, with the AI stuff. And I mean, I live in Southern California. We're right next to Altadena, California, that lost 9,600 homes. And Southern California Edison you wouldn't believe the amount of ads for lawyers you see. So they're going to
Right.
get sued. PG&E, I don't know that it's a great business. It's government regulated, but they're all of a sudden they're kind of a hot tech stock because of the data demand and the energy. But hey, talk to me a little bit about the breadth. For a long time, we had such narrow breadth. Everything was Mag 7 and it got so overweighted. And then I think the breadth has been increasing, but maybe talk to me about that, or talk to our listeners about that and the health of that. And then maybe, the other thought is coming off this extreme bottom April 7th to this big return till now. That's kind of shocking. It almost feels like that COVID bounce, right? Where it went down so much, maybe even more so.
Yeah, I'm happy you mentioned that because I was definitely going to let us slide without talking about the breadth. And it's really important because it's actually one of the most interesting things that we're seeing on the Dorsey Wright platform. So for you listeners, when we talk about breadth, we're talking about how many stocks are moving up or how many stocks are moving down, right? And so we can say, hey, if breadth is strong, that means that a lot of stocks are moving up. If breadth is weak, that means that a lot of stocks are moving lower, whatever it may be. And so, you think back to a market like 2023, 2024, for the most part, where it was really just a handful of stocks leading the market higher. And when I mean handful, I mean maybe six. Breadth was relatively weak, right? Because markets were moving higher, but a lot of stocks weren't the ones leading the way. It was just a few, right? And so in 2025, what we've really seen so far is a massive washout, right? Every stock just liberally across the board fell down to multi-level lows. In terms of our kind of breadth indicators, we look at the bullish percent, which measures the percentage of stocks that are on a point and figure buy signal. There's a lot of NDW jargon in there, but the point being is we want stocks to be on buy signals. So if that value is low or weakening, that's a bad thing. So we got down to a value of 14% on our most recent exhale for the S&P 500. That's the lowest that we've seen since kind of the lows in 2022. So, about 1 out of every 10 S&P 500 stocks trading on a point and figure buy signal. As of today, the time of this recording, we're up at 74. So that's a difference of 60% that we've seen over the course of this rally. And the rapid ascent, to your point, that we saw was about a month. That was the quickest trip down from below 20 to above 70 that we've seen since, you guessed it, the COVID bottom. And of course, that's coming what's preceding a pretty good year, of course. But there are some other interesting points in there as well that aren't necessarily as strong, right? 2002, right? We saw a kind of massive breadth increase. 2020, 2022, kind of late 2022. So point being, the most recent one, or most positive recent one, that is COVID, but there are certainly some other ones in there that, are massive swings in either direction that aren't necessarily as positive in the near to intermediate term.
Yeah. And I guess talk to me real quick, because I was just reading some of your stuff, but maybe you can summarize it in the short run, what that means coming off such lows and then to such highs in a short period of time. But there's sort of what that means in the shorter run, and then maybe in the longer run, at least historically, what that has portended. Is there info your data shows on that, or do you have a thought around
so
that?
we've got a subset that kind of the table that I'm looking at here, and the listeners aren't looking at it, but I am. It's about 10 instances where we move from below 20 up to above 70 in rapid figure, if you will. In near term, 1 month and 3 month, on average, we're negative, right? Down about 0.3%. And then in the 3 month time frame, we're up about 2%. So, still relatively average in 3 month time frame. 1 month gets a little bit more choppy as markets try to figure out what they're looking at. Then in the kind of 1 year time frame and 6 month time frame, things are more positive. So that same subset there, the average returns 1 year out, 15%, median is 17.63. So, the longer term picture, most of the time, these washouts are stoutly positive. In the near term, you kind of get things that are a little bit more confused. Market participants really don't know what direction they want to go. But in the long term, most of the time, things are positive. I say with a caveat of, you look at something like 2001 and 2002, where we got a somewhat rapid ascent out of a kind of depressed field position. Markets were down. That was the dot-com bubble. So there are periods on either side of the spectrum, but on the average standpoint, things are pretty positive.
Yeah, that's great. I'm thinking back to my last episode was with an economist. That's very different skill set than what you do. Strider Alas, senior economist at First Trust, but he was in reference back to the breadth. He touched on sort of this AI, and everything's been centered on the Mag 7, but he thinks a lot of the benefit will be to the other 493, in the S&P 500 when all is said and done. So it's interesting to watch how these things flow, and your work has been so helpful. This has gone on. I want to respect your time, but we got to have you back, because there's just so much going on and so much nuance it's tough to cover in, 30, 35 minutes. Really appreciate anything else you'd like to share? Any closing thoughts or big points we might have missed or things people should be thinking about?
Yeah, I mean, first off, just great pleasure being on today. As always, I think this is our third podcast now, and it's always great just being on, talking through what we're seeing from the markets. I think the maybe closing point is really just to reemphasize what you and I opened with, which is there is undoubtedly between the time today where we speak and the next time that we speak next quarter, there is undoubtedly going to be a lot happening, right? Whether it's tariff news, whether it's some other world event, whatever it may be, hopefully it's all good. But there's undoubtedly going to be plenty of action that is going to try to get you to take action one way or the next, whether you're buying or selling. At the end of the day, really just remember that the only thing that we're all trying to do is find assets that are going up most of the time. Unless we're short, then we want them to go down. But for the most part, right, that's the ultimate goal. And so watching the charts, having a process in place to weed through those headlines that are constantly bombarding you, that's the major key. And ultimately not chasing those near-term flashes in the pan. We talked about internationals. I'm not calling that a flash in the pan because it has been about 6 months or so of that. But to that point, we're not trying to focus on really what's just done well this week. We're trying to focus on what's doing well over the course of a decade in your overall financial picture. So I'll wrap up there because I can ramble so well. But point being, thanks for having me on.
Oh, of course, Miles. It is great. We'll do it again soon, and I think it's so helpful. I utilize this info all the time. I share it with clients from just a wisdom standpoint. It's super helpful in making decisions. And we are, may we live in interesting times. Well, we certainly are. So, but we're seeing a lot of things move under the surface. Your work's been super helpful and helping me see that and watch where the puck's moving. And we're still somewhat cautious. I guess there's so much discussion on inflation, right? Is it going or what? I mean, in reality, I think most people, and my own experiences, things are going to cost a heck of a lot more in the future than they cost now. And if you've been around the planet for any length of time, you just cannot believe what things cost. So the best thing is to have assets that are growing. You need to protect on the downside too, but you better have growth in those assets. Still the best strategy to preserve your cost of living standard, et cetera. So really appreciate you coming on, Miles. This is great. We'll do it again soon. Super appreciate having you as a partner in this process. And thanks everyone to listening. Please like and share this, and or let me know if you have specific questions. We can get them answered right here. Kind of a ask me anything. We're an open kitchen concept, so we'd love to take it on, but we are utilizing a number of processes to kind of figure out what's going on. Or sometimes, as you might allude to, we don't always know why immediately, but we can see something's going on, and we at least want to pay attention to that and be mindful of that. And later on, the answers may come. But if we can see that trend, and your work has helped tremendously with that, Miles. So thank you so much. So make it a great day. It's great to be with you. And thanks, everyone. Take care.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC-registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.